Good evening, and welcome to the Professional Development Webinar. My name is Sharon Bernardi. I'm the Executive Director for the Federation of Tax Administrators. FTA was founded in 1937 to assist departments of revenue with their administration efforts. Prior to joining FTA in 2022, I was the Chief Deputy Comptroller of the state of Maryland. I'm a proud member of the Advisory Council for the Black Leadership Circle. Our auxiliary group, which is powered by Associated Black Charities, responds to a need for progressive, inclusive, and supportive safe spaces for Black executive leaders. Additionally, we respond to a need for capacity building, work focused on creating a supportive pipeline for Black professionals. We also respond to a need for Black executive leaders to convene, connect, and align themselves in a new way that amplifies the influence of our collective voices. On behalf of the Black Leadership Circle, I'd like to welcome you to our second professional development webinar. Given the impact tax laws and regulations have on business owners of all sizes, the BLC wanted to provide this professional development opportunity to the community. Tonight, we will discuss unlocking tax strategies, exploring Fed and SALT, which is state and local tax essentials. And this evening, I will be joined by two highly esteemed colleagues, Attorney DeAndre Morrow and Attorney Beverly Winstead. So without any further delay, I'd like to invite our esteemed panelists to join us, and I'll begin with their introductions. First, we have Beverly Winstead. Beverly manages her law practice, representing individuals and businesses in tax disputes. She directs the Low-Income Taxpayer Clinic at the University of Maryland. As the first person of color, she led the MSBA tax section from 2018 and was recognized in top 40 under 40 lawyers. As vice president of the Louis Eddy Winstead Memorial Fund, a 501c3 organization, she facilitated over $20,000 in scholarships. She advises her family's organic farm, Abanitu Organics. Winstead graduated from the University of Maryland School of Law and is inducted in the Hall of Fame as a basketball player from Bowie State University. Welcome, Beverly. Also joining us this evening is DeAndre Morrow. Mr. Morrow specializes in state and local tax issues, often counseling tech firms in Maryland, Virginia, and DC. DeAndre draws on his previous experience as a government tax attorney for the Comptroller of Maryland to guide his professional approach. He uses this expertise while interacting with state tax agencies for voluntary disclosure agreements, settlement agreements, and developing tax saving strategies. He has been recognized in top 40 under 40 by the National Black Lawyers. His involvement extends to numerous professional committees within the tax sector. He co-authored publications on DC real estate and has served as chair on the Silver Spring Citizens Advisory Board. So I'd like to turn it over to our colleagues, DeAndre and Beverly.
Thank you so much, Sharon. It is a pleasure to be here. Beverly, as well. And before we get started, we just wanted to provide this notice. We're not going to read it verbatim, but this is just a general notice to let you all know that this is the lawyerly thing to say, right? This is not tax advice. This is just general information that we are providing, and we highly recommend that you consult with your tax advisor as it pertains to the relevance of any items discussed today, because there surely is no one size fits all approach when it comes to taxes for different entities. And with that disclaimer, we can get into everything. Beverly, did you want to take it away?
Yeah, I'll take it. This is always a fun topic for us, right? We talk about, tax strategies and how we can help business owners, I think, avoid, basically be proactive in their tax strategies as well as protective, right? Because I think DeAndre and even Sharon, as you have been doing this kind of work for a long time, lots of times people come to us when they're in trouble, right? And so the purpose of this is hopefully to give these business owners the information that will prevent them from seeing us when they're in trouble, but definitely give them some information that we think can help them on the front end. So we're going to start by really an introduction to federal taxation. You can see the purpose of federal taxation and its impacts on businesses. We're going to talk a little bit about elements that businesses need to manage, which income tax, payroll tax, excise taxes are all relative, I think, to this discussion. Some of the key regulations really, I think, that are most important really have to do with payroll. We want to make sure you understand your payroll obligations, because payroll is a huge area where we see businesses constantly getting tripped up. And then also just making sure that sometimes as an employers, your responsibility also is to make sure that your employees, to a certain extent, whether they're employees or independent contractors, understand their tax obligations also.
Right. And just at a very high level, right? So we're also going to dive into some essential components as it pertains to state and local tax. As you know, from Sharon's note, state and local tax is, it's an essential component of our tax system, commonly referred to as SALT. These taxes play a pivotal role in shaping the economic landscape for our communities and directly impact businesses all across, across various industries. So state and local governments, they use these taxes for critical public services. And of course, everyone wants to pay their fair share. But, we also want to make sure that, we as business owners are structuring our businesses to make sure that we are not over leveraging ourselves, right, and paying our fair share. The landscape of state and local taxation is very complex, and it varies, right? Because no two states, tax, and often no two cities handle taxes in exactly the same way. This diversity has a profound significance, in influencing business decisions, from determining the best location for expanding operations to managing effective tax rates to enhancing profitability. So we hope, as we proceed, we'll explore different tax types, different types of SALT, including income taxes, sales taxes, use taxes, which are two different things and very important for business owners to understand. Property taxes, and payroll taxes, so on and so forth, right? Each of these taxes has, unique considerations and challenges, especially when managing a business, that operates across multiple jurisdictions, as most businesses in the DMV do. So my goal tonight is to provide you with a baseline understanding of these tax types to help you better navigate the complexities that they present and leverage this knowledge to benefit your businesses. So I just wanted to start with some key concepts, right, in terms of state and local tax. The first one is the concept of nexus, right? This is a generic term used to indicate that a company, a taxpayer, has sufficient presence in a jurisdiction for that jurisdiction to require tax collection responsibilities or to impose tax liability. This stems from the U.S. Supreme Court requiring substantial nexus under the Commerce Clause and sufficient contacts under the Due Process Clause. Won't get into those intricacies, but I think it's important to just have these concepts in your mind, right? So sales tax. Everyone knows sales tax, right? That's imposed on retail sales of, tangible personal property and certain services. But an important component is use tax. Use tax is a complement to the sales tax, and it's imposed on the in-state use, storage, consumption of these same taxable, tangible personal property items, or, taxable services, to the extent that those services are taxable. In general, states imposing a use tax must give a credit for sales tax paid on a product, you know, to another taxing jurisdiction. That's, I think, something that companies often lose, you know, a benefit they often lose by not making sure that they leverage that rule. Another concept is apportionment. And this is going out to you know, all of you businesses operating in multiple jurisdictions, businesses that you know, are preparing to expand and operate in multiple jurisdictions. Apportionment is a mechanism that states use. It's for used to divide a multi-state corporation, right? A company you know, operating in multiple states, you know, divide their income, right, for taxing purposes. So apportionment assigns income to a state by way of a fraction, representing a ratio of in-state factors to total, you know, total factors, rather than separately tracking items of income where the income is generated. And of course, you know, audit preparedness, right? This is just a general concept, right? You know, you always hear people saying, "Oh, I'm under audit." But tonight we're going to talk about what that actually means and why it's important to be, you know, prepared for those different types of scenarios, because I can tell you firsthand, a sales tax audit is much different than an income tax audit, you know, and so on and so forth. So let us proceed. And
So-
go ahead, please.
No, I was just saying the next slide is the intersection of federal and SALT. So I think both of us are going to talk about that. But let me just share with the audience, because I'm a huge proponent of, if you attend a webinar or an event, you're showing up because you have questions or you want to get some information. So we want to make sure we give something of value to you also. So make sure if you have questions, I can see in the chat now, you're being encouraged to ask questions and leave comments. So definitely use this time. Now is your time. You know, DeAndre has his billable hour rate, so does Sharon and I do, but you're getting us for free, you know? So make sure you ask your questions. You know, but definitely make sure you answer your ask your questions. So going back to the intersection of federal and SALT, there is a lot of intersection. You know, I practice more in the federal world. DeAndre practices in the state a lot. But there are many times when I call you, DeAndre, and I say, "Hey, I got this issue, you know, can you help me with it?" Right? Because again, there's a huge intersection between it. We see a lot of the intersection happen with audits. Right. So the inconsistencies between the state filings and the federal tax filings, that's something that can trigger an audit. So particularly when you're a business owner, you want to make sure that you are filing the correct forms, and whether it's payroll tax forms or income tax forms, they have to be consistent. Yeah, so that's one thing. The other thing is, let me skip down to employment taxes, because the obligations with employment taxes, and in particular with worker classification, we see a lot of worker misclassification. That's when someone you may consider as an independent contractor, because they may, you don't withhold payroll taxes, right? They may sign a contract with you. You don't want to go through the process of actually putting them on payroll, which can be, you know, burdensome. But there are tests out there that says whether or not a person is an independent contractor versus an employee. So you want to be aware of those tests. And at the state level is actually more rigid than IRS level, right? So you want to make sure you're in compliance. I always say, you want to be in compliance with definitely what the state says.
Right. I mean, and this
gig
goes,
economy.
this, oh no, I'm sorry. Go ahead, Sharon.
I was going to say, and with the gig economy, I think it's becoming even more complex and people have to be aware.
Mm-hmm.
Yeah, no, absolutely. And I was just going to say, I mean, and this goes both ways, right? So, you know, as Sharon mentioned, I cut my teeth in sort of state government, right? So I was at the comptroller's office, working at, you know, as a staff tax attorney, and I saw firsthand how much interaction there was between the state and the federal government. If you don't think that there's talking there is definitely talking, right? So, just because you didn't, notify the state of an audit, or, you didn't notify the federal government of this state issue, there is talking across lines. That, they're definitely exchanging information under sharing agreements. So you need to make sure that there are consistencies in your filings. In that point, in terms of consistency in your filings, right? For most states, right? The root, right? Sort of the base, right? For coming up with, that your taxable income, it's based in federal principles, right? So it's, most states adopt federal tax definitions or comparable provisions as their foundations for determining your income tax liabilities. So that means two things, right? Your numbers need to be consistent, obviously, but you also need to be aware, as a company that operates in multiple jurisdictions, that you have to be strategic in having your returns prepared, and items documented, and have great records, because of the fact that these federal tax definitions operate as the base. There's often instances where a company could be subject to tax on the same income in multiple jurisdictions when they operate in multiple jurisdictions. That's why they have this concept of double taxation, when you are a multi-state entity, and often it comes down to your documentation, you being able to prove where that income should have been sourced, because they're all looking at the same pot, right? Your business made $1 million, right? But you can't tell or prove where that $1 million went. There's a possibility that both states or multiple states would try to grab a portion of that, if you don't provide them with an appropriate mechanism for apportioning and allocating that revenue. So that's the main thing I wanted to note on that piece.
Before you transition, I know you shared about federal data sharing, but the states also have those same agreements and share information and may collaborate.
Yes, that's extremely important. All right, this one, we could be on this one all night. So you want to start? You want to start, Bev? And I'm just gonna jump in wherever, because I could go.
I mean, I think the reason why we put this in here really is because you never know, like, what level business owners are when you're talking to them, and when we have these webinars like this. So I find that this is a consistent question that I'm often asked when we talk about tax strategies. So we wanted to make sure, since you guys are unlocking your tax strategy, is that the correct business structure, the way you structure your business, really, really, really matters in terms of tax savings, right? I believe it was Judge Learned Hand. He's the one that said that there's no patriotic duty to pay a lot of taxes, right? To pay the most over to Uncle Sam. So anyone can arrange their affairs in a manner that reduces their tax burden. So, and that's just paraphrasing what he said. And the way you do that, a lot of it has to do with how you structure your business, right? So there's a difference between being a sole proprietor versus a partnership versus a LLC versus an S Corp versus a C Corp, right? And so we often find ourselves counseling business owners as to what might be the correct entity. And let me also say this, and DeAndre, you can chime in. How you start off, you may start off as an LLC or a sole proprietor, but it's always good to kind of reevaluate, I would say, intermittently, as to whether or not that is still the correct entity for you, right? Because you could save a lot by simply just making sure you are classified a certain way.
Absolutely. And I harp on this, right? Sort of the restructuring piece. But before we get to this, I want to go over just rudimentary terms, sort of each entity type, right? Of the ones listed. Because I have some pain points, so I'm gonna use, they told us we have until 8:30. So I'm gonna spend a lot of time on this slide to sort of complain about some things and make some
8 o'clock.
suggestions. 8 o'clock? Oh man, I was gonna go, okay. I was gonna go until 8 on this one. Um, but and just as a caveat, right, each business structure carries its own set of implications for tax purposes. So it's essential to consider, how the entity type you choose will impact your tax obligations in the specific jurisdictions where you operate, right? And I'm talking, from a state and local tax perspective there. But let's explore these structures just at a high level, right? Starting with the simplest form, sole proprietorship, right? That's just you. You started your business and it's you, and you didn't incorporate anything, right? So it's easy to set up and it offers a complete degree of managerial control. However, in terms of tax, the owner is personally liable for all taxes. There generally there are no special advantages, from a tax perspective at the state level. The structure is straightforward, but it does, allow for exposure, to the owner, to potential personal tax audits, and liabilities, right? Because if you're a sole proprietor, you have to provide your personal returns, right? You have to provide, all of those things. So, you are opening yourself up for personal, tax liability in your personal records. The next one, partnerships. This includes general partnerships and limited partnerships, and it allows for a partnership allows for shared responsibility, and there are potential beneficial tax treatments, especially from a state and local, perspective. And there are some considerations, for, pass-through taxation. What is pass-through taxation, right? That's just where income is taxed at the individual partner level and not at the entity level. And there are some caveats where some states are allowing partnerships to be taxed at the partnership level now. Or at the entity level, and then, giving credits to the partners. But, just at a very high level, this can be advantageous in states where, states have favorable individual tax rates, but it does require very, very careful accounting to ensure that, each of the partners meet their tax obligations. S corporations, these are also pass-through entities, right? I said, tax, the income is taxed at the individual, partner level or shareholder level for an S corporation. However, S corporations have to adhere to strict eligibility requirements, including, limits on the number of shareholders, shareholder residency requirements, and obviously I'm talking about this from a state, and local tax perspective. And this structure is particularly appealing in jurisdictions like Virginia and Maryland, where double taxation could lead to, more significant implications in those jurisdictions. And I believe it was stated, DC, Maryland, Virginia, those are my focus states. So I may, talk about those states more. That doesn't mean that, this doesn't have applicability in other jurisdictions. It's just, I'm going to my bread and butter, right? So, so as to not, veer off. Finally, there are, well, I'm gonna go back to limited liability companies, and I am jumping over that I did jump over that for a reason. So C corporations, they're taxed at the entity level, and again, the shareholder level, and again at the shareholder level when dividends are distributed. This is known as double taxation. However, this structure may be beneficial in scenarios where the business needs outweigh tax advantages, right? Raising capital, for the sale of stock, right? Or just raising capital in general. I want to rest here for a minute though, when talking about C corporations. So I'm gonna get on my soapbox if y'all will allow me. So often I hear, small to medium-sized businesses either talking about sort of at the outset, when they're thinking about entity formation, or after they've already formed the entity and then they come to us, with tax issues or for, further just, strategy. They go with the good old Delaware corporation. Delaware is their state of incorporation. It's widely known that Delaware is a popular state, among businesses, due to its well-established, corporate law structure, business-friendly courts, and lack of, obviously, a corporate income tax for corporations that operate outside of Delaware. However, incorporating in Delaware is not always the best choice. It's not, and there's several reasons why. Delaware has higher costs associated with incorporation and annual fees. So, being being a company incorporated in Delaware but operating in another state, that you still have to register as a foreign entity in the states, where you operate. So that's leading to, double or triple or quadruple, the administrative and filing fees, and while Delaware courts are renowned for their corporate law expertise, smaller businesses that are less complex don't always need that. You don't always need to sort of, choose this forum for their legal system when you're not going to utilize it, or you don't anticipate utilizing it, or your company just doesn't have complex legal issues. It's a straightforward business model. Although Delaware doesn't tax out of state, income for corporations, this doesn't really result in tax savings if your company operates in other states, because of that concept of apportionment that I talked about, right? Businesses still have to pay taxes in the states where they operate. And that's not just your home state, that's, states where you're engaging in business activities. Additionally, other states may offer more favorable tax incentives, or credits, for companies that are, in their, incorporated or established in their jurisdictions, right? That's more beneficial, than for furthering your business operations. And finally, this is is the one I probably hone on the most. For companies with a significant physical presence outside of Delaware, it probably makes more sense to incorporate in whatever state you have the most significant, like the most significant, your most significant presence. I'm sorry. This presence establishes nexus, as we've discussed, and obligates the company to comply with the local laws, negating most of the advantages of being a Delaware entity. So I'm going to step off my soapbox, and then I'm going to jump back to a limited liability company, because let's say the second, most common structure is the limited liability company, right? It's easy. It offers flexibility, in protection from personal liability. I'm not going to talk bad about limited liability companies. I love limited liability companies. I think it's, a good mechanism. You can choose to be taxed as either a pass-through entity or a corporation. That's something you need to do when you're setting up the entity. This is sort of like a no take back thing there. And this flexibility allows for strategic planning around state income tax rates, apportionment, methodologies, and that significantly impacts tax burdens. But once again, going back to what we said at the outset, business structures, vary, right? And this is all depending on your particular business model. Every structure carries its own set of implications for tax and business purposes. There's no one size fits all approach. So, I strongly advise consulting with a tax professional that understands the nuances of your businesses. Now, most of you here, entrepreneurs, you're probably like, well, that's good. I wish you would have told me this, 5 years ago, 3 years ago, maybe 2 weeks ago when I incorporated my business. But going back to what Beverly said, right, there's definitely opportunities for restructuring, and there's times for restructuring. Not everyone needs to be a C corporation at their outset, right? If you're seeking external structuring, external funding, restructuring to a C corporation might be beneficial. When should you do that? When you start seeking that external funding, right? Because what do you have to do when you have a C corp? You have to establish a board, right? There's corporate formalities you have to adhere to that you wouldn't have had to adhere to if you were, a sole proprietorship or a limited liability company, right? As your business grows, the simplicity of certain structures just might not suffice. So there are times when there is a time to restructure, and once again, consult with a tax or legal professional, or tax and legal professionals like us, to guide you through when it's the right time to sort of change course. And that's all I have on that. Did either of you have anything?
Yeah, let me chime in a little bit, because I'm gonna jump on your soapbox for a minute. You can pass it over to me. No, I mean, this is very true in terms of making sure you're the right structure, and also reevaluating your structure. And we saw a lot of this during COVID when Congress released the PPP funding and the EIDL funding. Many small Black-owned businesses in particular, they did not really get the PPP funding that they ordinarily probably should have gotten. A lot of them were S corps and they did not have themselves on W-2 salary, which is really a requirement for being an S corp. That's why I said it's important for you to understand these various entities. And so the PPP funding was actually calculated based upon what your W-2 earnings. Well, guess what? If you structured yourself as an S corp and you did not have a W-2 salary, you missed out on the PPP funds, which was designed to actually help you get over the hump during COVID. So it's very important that for this part, this is probably one of the most important things I think when you're thinking about being in business and trying to figure out, how you're going to unlock the benefits of being a business owner. And also as far as the tax code, definitely understanding the business structure.
Yeah, absolutely. And I'm going through some of these. Let's see where we are on time. All right, we have some time. I'm going through some of these questions, and I'll try to answer them in the appropriate slides. We'll try to answer all of them. But one question I see is how do these taxes laws impact or relate to nonprofit tax exempt organizations? So my perspective, so not so tax, not tax exempt law is tax exempt law is actually one of my areas of focus. And I'll say this, right? Maybe not as it pertains to business structure, but certainly location, right, of incorporation, as well as applying for certain exemptions, right? So at the Comptroller of Maryland, one of my functions was I reviewed applications for sales and use tax exemptions, and nonprofits had to apply for these sales and use tax exemptions. And, we looked at everything from their state of incorporation to their IRS documents, as well as sort of what the entities did, right? So knowing, being in the right jurisdiction, knowing where to apply, what to apply for, that sort of plays to, I guess, learning how to incorporate in the right jurisdictions. And also, we will go over this in some other slides, and perhaps I should go back a little bit and talk about sort of sales and use tax. Conceptually, I think there's a misconception as it pertains to nonprofit organizations often when it comes to, sales and use tax, things that they can make purchases on, sales that they can make. I actually quite often do voluntary disclosure agreements for nonprofit organizations that thought, hey, we thought that, our sales were exempt from tax, so we were selling, this item, or this, and we didn't realize that, we should have been collecting tax, so it's important to know the jurisdiction that you're in, know their laws, and know what you are supposed to be doing as a nonprofit, right? And I'm talking about all nonprofits, 501c3s, 4s, 5s, 6s, and, because there are actually variances as it pertains to, exemptions for those types of nonprofits. For the most part, all the tax exemptions at the state level that you're, familiar with hearing about, those primarily pertain to 501c3s, right? Some of them pertain to other organizations, other tax exempt, entity types, but for the most part, 501c3s are the ones that are afforded, those benefits. And again, those benefits don't extend to every single type of sale and purchase. So, that's my piece in terms of how, these laws impact nonprofit organizations. I'm sure we'll get into some other components. Beverly, did you want to add anything, or Sharon?
Yeah, I would say a misconception that I've heard also with nonprofits is that they think that they don't have to pay, like you said, any taxes. And so we've worked with nonprofits who have fallen in the trap of not paying employment taxes, right? Because they didn't know that they were supposed to remit and withhold taxes and send it over to IRS or the state. So the tax obligations are, even for a nonprofit, are very similar in a lot of instances to for-profit organizations. So definitely be mindful of that.
Absolutely.
I'm
And
glad you raised that because what people don't necessarily know, what you both mentioned, the withholding employment taxes as well as the sales and use taxes, they are trust fund taxes. And so there's stiffer penalties when you make those errors, even if they are errors and were not intentional. And I think that also ties to the structure discussion that you had, because depending on how you're organized, you become personally liable for those trust fund taxes, and certain officers, members, depending on that business entity structure you selected, are the ones who would be held responsible for paying. And I'll try to find the comptroller tax tip on at least the sales to and by exempt organizations, because what you point out is key, is a distinction whether you're making a sale or whether or not you're the one who is having an item, you're purchasing an item.
absolutely. So jumping and for all the other questions, we see them and I think we're just going to answer them in the appropriate order when we get to those slides. All right. And I can start just talking through, you know, some of the audit red flags and innovations. And one of the things we've already noted, and we put it in here twice because it's that important. Inconsistencies between state filings and federal returns will get you popped. We see it all too often. You know, these inconsistencies are caught, they're flagged. You know, and this is a common audit trigger, you know, in 2024 and really in multiple years. You know, large year-over-year variances, you know, we completely understand, and it's not uncommon, especially in this day and age, right? You know, we're coming out of COVID, and there have just been huge fluctuations in business growth, or shrinkage. But, you know, large year-over-year variances are definitely something that, you know, are act as red flags. And if that's just the case, that's how where the numbers fall, you know, over you know the course of 3 to 4 years, that's fine. But all that means is you should be prepared, you know, as you really always should, but you should be prepared by having adequate documentation to substantiate the year-over-year variances. Bev, do you want to take the other few?
So let me go back to what you said while we keep
Oh, please,
talking about these audit flags and
let's
things,
do
and
it.
even we'll talk a little bit about, you know, collection. Most of you know that IRS got $80 billion, right? They got $80 billion in the Inflation Reduction Act. If I believe it was that was the act. What we've seen as tax practitioners is a huge uptick in IRS audits, in state audits, as well as collection activity. They're actually doing a lot more enforcement. So the reason why we keep sharing this with you is because we want you to be aware of that, number one. Number two, we also want you to make sure that you have your ducks in a row. And having your ducks in a row really means that you have good records when it comes down to substantiating, as DeAndre says, the expenses that you claim on your tax return. I think Janisa, she had a question about finding a good, I think, professional to work with, because it sounds like she wants to be prepared, she wants to be ready. And you know, DeAndre and Sharon, we had this conversation yesterday. We talked about what is it that we would share with you when you're actually looking for, I think, a competent tax person to work with. And, you know, we're a huge proponent of really, I think you have to first figure out what it is that you're looking for in a professional, you know, so definitely write down if you want someone that has one-on-one attention, someone you can call, someone who has the expertise in a particular industry. You want to think about some of the things that you want too, right? I'm also a huge proponent of people, quite frankly, that are licensed. And the reason why I say that, whether you're licensed as an attorney or a CPA, or even an EA, because we have, I feel like, a lot more skin in the game. So if we screw up, I mean, we're with there's a governing board around us. And I think in this tax realm, it's so critical that you guys understand that it's entrepreneurs, because both DeAndre and Sharon worked at the comptroller's office, and they shut down a lot of tax professionals that were really filing bogus returns, right, Sharon? Yeah. So there's a
Yeah.
whole program that the comptroller has in place, and you can talk more about it, to really stop preparers that are really just bad actors, but you don't want to be caught up in that, because you're going to still be responsible for the taxes if they screw you up. So I'm definitely a huge proponent of that. I'm a huge proponent of really understanding the policy of your advisor. If they make a mistake, are they going to be responsible for the penalties and interest? A lot of these people are doing, I've seen people that do up to 600 returns, 2,000 returns one time I saw. They're going to make a mistake, doing those, it's just human nature. So you definitely want to make sure you understand, their policies behind if they make a mistake, and whether or not you'll be able to track them down if they make a mistake, So those are things that I think you have to kind of think about. And I know you have other resources too, Sharon.
Oh, related to that, I mean, there is a DLR, Department of Labor manages it, but they have a tax preparer board, and you can visit their website. I'll look for that link, and you can actually look up CPAs, you can look up licensed tax preparers, and I agree with Beverly that you should have someone who's licensed, because they are regulated. And if there are complaints made against those preparers, then they can have their opportunity to prepare returns taken away from them. And Maryland actually just passed a bill in this last session, and I'll put it in the chat. And it's to have stiffer penalties for preparers who have, as you mentioned, engaged in these types of returns wherein they've requested overinflated refunds based on undocumented business expenses, deductions, et cetera.
Absolutely. And to piggyback on what Bev said, $80 billion, right? And what does that, I mean, what does that entail, right? I mean, they created a special they've created special divisions, right, to handle, audits on sort of a larger basis, right? It's particularly for pass-through entities. They say large, pass-through entities, but that doesn't mean that, mid-sized pass-through entities aren't going to be swept up, in these enhanced, compliance efforts. So, that just sort of heightens the need for, better documentation. And we do have strategies. We're going to get to those, we're holding on to them for the, in the end, but we do have sort of some suggestions or recommendations of, software, or techniques that you can use, right, to increase your risk management, or to decrease, to decrease your risk, right? Risk management strategies. But, we also wanted to note, right, the IRS is becoming, and the states are becoming more, sort of technologically advanced, right? They are investing in new technologies and utilizing the same things that we are, right? They're utilizing artificial intelligence, and analytical modeling to come up with better ways to target people for tax compliance, right? More effectively. So, be aware of that. This is, in 2024, we're in the future. So, we just have to be cognizant of that. The last bullet is a piece on, this is specific to state and local tax. I don't know if you all are aware of a case, in 2019 decided by the Supreme Court, known as the Wayfair decision. And yes, Wayfair, like the furniture company, right? So 2018, there's a decision, South Dakota v. Wayfair, and it pertained to, economic nexus, right? So there's long been this concept of physical nexus, right? We talked about nexus, in the beginning, right? That's the connection that you have with the state, those sufficient contacts that allow for a state to, or state and local jurisdiction to, tax, the income, derived, or tax sales made by, require the collection of taxes, you know, on a company. So now every state with a sales tax has an economic nexus requirement for, you know, remote, you know, out-of-state sales following this decision. An economic nexus generally requires out-of-state sellers to register in those states and collect and remit sales and use tax once they meet a set level of sales, or you know, a set level of sales, right? Like a number, you know, a threshold, you know, $100,000 in sales, $500,000 in sales, or, and this is very important, a number of transactions within the state. You know, so often I hear, you know, companies, very sophisticated, very large companies come and say, oh, well, you know, we just entered this market and we haven't yet, you know, crossed the economic nexus threshold, so we're fine, we're not worried about it. And I'm like, no, the threshold was 200 transactions. Y'all did that in the first 15 days. You know, you crossed the threshold. So be cognizant of this, right? Because states are looking to track down, you know, instances where, yeah, you may not have, you know, may not yet have met the financial threshold, or the revenue threshold rather, but you have met the transaction threshold, requiring you to register and collect and remit sales tax in those states.
And as you referenced, DeAndre, the timing of when you are required to file differ among the states. And that's something to be cognizant of, and difficult to track because the grace periods vary from state to state.
Exactly. Yeah, absolutely.
Yeah, I also want to just, I see Tom has a question about business, whether or not we're going to be covering business tax credits. I think we may have one slide that talks about generally, but really more at the federal level. The problem with, I think, doing it at the state level is states are very specific when it comes to business tax credit. What DC offers, Maryland may not offer, versus Virginia. And so in a format like this, we wouldn't be able to cover really business tax credits. I think as business owners, you should be aware that you might be eligible for certain business tax credits. And that goes back to the conversation we just had about making sure you have really good and competent a good and competent tax professional, and maybe even someone who is used to kind of working in your industry, because they would know what credits that your particular business would qualify for in that jurisdiction.
Perfectly stated. Yep. Thank you. All right, let's talk about sort of being proactive, you know, things that you can do to mitigate these risks, you know, some internal controls, some practices you can implement. And the first thing, you know, and it's, you know, a shout out to my wife. She just texted me and told me she's on this. I was hoping she wasn't, because I was gonna throw her under the bus with this. But so I'm gonna be a little more gentle. But you know, so my wife is you know, she's an entrepreneur. She owns her own business, and she absolutely hates, you know, her what I think she calls them her money days, you know, where she has to sit down and you know, go over all her records, and you know, sort of, you know, reconcile and you know, track. And this is outside of, you know, sort of working with an accountant, right? Because you know, you have to have these records to send over to your accountant. You do not want, I promise you, accountants and tax attorneys hate, right? Hey, look, it'll cost you more because, you know, most of us bill by the hour, but you know, if you send them, we'll do it. But it's a lot easier for you. It probably will save your business more money, you know, allow for more deductions, you know, protect you, you know, at the audit phase. If you know, establish a practice of, you know, set some internal controls, right, to make sure that you are routinely reviewing your transactions, to make sure that, you know, things are happening as you believe they are. And you know, that shifts are made where necessary, right? So have strong internal controls to prevent errors, right? You know, have a day, you know, once a week where you look at your records, right? Look at your expenses, look at your filings, track your mileage. Track your mileage. I'm talking to my wife. Track your mileage. you know, and these practices will save you money. You know, it'll save you tax dollars. It'll save you, you know, tax preparer dollars. It'll save you, you know, tax audit dollars, right? Just because a company, you know, has perfect records doesn't mean they won't get audited, right? You know, companies with perfect records get audited all the time. It's just the audits are very quick. You know, so make sure your documentary practices are sound. And as it pertains to legal compliance, regularly updating your knowledge base on federal and state law changes, I understand that's hard. And that's why we're here, right? You know, I offer this to anyone here. Feel free to you know, email me after, you know, whether you're a client or not, if you want to jump on a listserv, right? And just have, you know, some routine updates go out to you, right? With updates, you know, on law changes, right? I my practice, you know, my DC, Maryland, Virginia, but I work on a 50-state basis. You know, I work with 35 other, you know, state and local tax attorneys, you know, so we routinely pump out guidance, you know, for multiple jurisdictions. But the only way that you're going to know is if you know, make sure that you have these practices of looking to check. You know, don't solely rely on your your professionals, and definitely don't rely on the government. Um, I'm gonna share a story about that actually, but I want to sort of get through everything else. You know, did you want to add anything, Beverly?
Why are
Great.
you making them wait on the story? Go ahead and
Okay, okay,
don't keep us in suspense.
okay. Well, here you go. So I had a client not too long ago. You know, they tried to do everything right from a risk management, you know, perspective. You know, their internal controls were in place. They had great documentary practices. They were a new business too, so it's like fresh start. You know, they're going, getting everything, and they they knew the laws. But what did they do? They went to go register their business, you know, with the government, and they got advice, bad advice, unsolicited advice from a government official. Told them, no, y'all aren't subject to that tax. Y'all don't have, and it was a trust tax. You know, Sharon talked about trust tax. Trust taxes, what are those? Those are taxes that you are holding in trust, right? You know, they're not it's not your money. You're holding it in trust for the taxing authority, right? The taxing jurisdiction. So, you know, what happens if you don't collect that tax that you were supposed to be collecting in trust? It's on you. It's not on the person that you made the sale to that you should have collected tax. You know, it's on you, right? So, you know, a few months after, or, you know, sometime after the business, you know, started and they were operating, the government came to them and said, oh no, y'all were subject to that tax. Y'all, you now have a large tax bill that you have to pay. I mean, and it was crippling. It was going to shut them down because they had not collected these funds, right? And this just is one of those instances where it's like you can have these risk management strategies, but you have to keep up to date and you have to consult with your professionals, you know, to seek help and advice, you know, with most every step that, you know, I hate to say it, but most every step, even if it's just a backstop, even if it's just sending something and saying, hey, you know, I just wanted to ask this, you know, before we make this major change, you know, what do you think? You know, it's not always time consuming on our end to look at something because we are regularly updating our knowledge base. We are, you know, working in this every day. So, you know, sometimes I can look at something in 30 minutes and say, oh no, you're fine. You know, that's 30, you know, bill you for 30 minutes, you know, and you're good. But you know, that's just an example of, you know, why it's good to be proactive. I wish I would have met them before, you know, they went and you know, because they had it right, but they were told otherwise, and they trusted it. But that's why you have to have trusted, you know, advisors from the outset.
Yeah, I've seen this happen on a couple of occasions also. And like you said, it's really devastating to the client when they thought they were doing everything right and they went to the uh government agency and the government that worker there told them that they didn't have a a obligation. So I actually have a client now where there's an email trail and the government person told them that they didn't have to uh collect sales tax. And I'm looking at the industry that they're in, and I'm like, I don't think this is right. Like, we need to we need to reevaluate this. I don't care what that email says. That's not right. You do based upon what Maryland law says and based upon what you do, you got an obligation to collect sales tax.
Yeah, yeah. So Valerie, well, the kind of businesses that must, it's not really, well, I guess charge, it's more, yeah, charge, collect a trust tax. So a trust tax is like sales and use tax, or sales tax rather. Like sales tax is a trust tax. It's a tax that you have to, it's not a tax generally in most jurisdictions because, like I said, the reason I love state and local taxes, I don't know why everybody tries to do things different. Everybody's trying to be a little different. So in some instances, the tax, the trust tax is actually imposed, it's imposed on the business, and the business has the ability to collect it from, or pass it on to the, their customer. But in most instances, the way that a trust tax or a sales tax works is it's a tax that is imposed on the customer, of the business, but the business is responsible for collecting that tax. And the best case is a sales tax. There's all other trust, meals
And
taxes.
withholding.
Right, exactly. Withholding, like things of that sort, right? You are holding this in trust, for the state. So I hope that answers your question.
Yeah, I like how you said you are holding it in trust, because that's what I always tell people, because we don't want to confuse you more, and we don't want you to get discouraged about being a business owner, because I actually love being a business owner myself. So we just want you again to understand and have information, and the reason why it's important that you've taken the time to actually join this webinar is because it also, as you're looking for that tax professional to work with, you can ask more targeted and directed questions, which will help you make a much more informed decision. And I think that's sometimes what's missing when you're trying to figure out who you're going to work with, is not really having the questions to ask that professional. But as you gather information, definitely, you can have a much more targeted and directed conversation with whoever you work with.
Right.
And
I'm gonna answer your question generally, Valerie, because I don't want to give tax advice.
Yeah, I was going to say
Well,
it's very
yeah,
fact intensive, all of these things, right?
exactly. Very tax intensive. But what I'll say is this: the way that state and local taxes are, especially sales taxes work, it's based on that specific taxing regime. And in most jurisdictions, it works like this. Tangible personal property is taxed, right? Like this, this phone, tangible personal property. Services are not always taxed. In some instances, the service has to be a listed service, in the statute that says, for example, resume writing services or writing services are taxable. In some jurisdictions, the law may be that all services are taxable. So you have to also keep in mind, the laws in the jurisdiction, right? Because there's instances in the gig economy where, you may be providing services for someone, you may be sitting in DC or South Carolina providing services for someone in California, right? Or New Mexico, where all services are taxable, right? And you have to know the laws, in terms of where that sale actually occurs, how it's sourced, where it's delivered. So it's very fact intensive. So there could in fact be instances where your services are taxable. And that's where you should consult with a tax professional to get very targeted advice.
And we're about to pop in the chat as well. Maryland is one of the few states that actually lists everything that is subject to tax, because a bill was passed several years ago for what tangible personal property is subject to sales tax and which services. And then to Valerie's question, where it does become fact intensive, and that would take up too much time, and maybe we can have a follow-up panel. But with resume writing services, it could be a question of if you're producing something that is tangible as a result of that. And then I don't know what's happening now in the digital space, how somebody may be receiving that. So as you said, we don't want to complicate things, and that's why you need the tax professionals.
So what are some what are some things you could sort of use? You know, what are some resources? And I believe we're going to share this PowerPoint afterward. So there, you know, but there are links in here. But what I will do perhaps during the Q&A session is I'll pull these links out and put them in. You know, what we've done is we've added websites, right, for, you know, small, large, medium-sized businesses, you know, go to these websites, right? The IRS has a, you know, business, you know, self-employed tax center. You know, Maryland does, Virginia does, DC does, most states do. You know, we just, you know, targeted this presentation to the DMV, you know, you know, for all intents and purposes, but, you know, use those resources if you don't want to, or, you know, go to a tax professional at the outset. Maybe even use them, you know, at the outset, right? You also use and leverage the, you know, professional associations that you have. The reason that we just have it generally stated as local chambers of commerce is because there's various chambers of commerce, you know, at the state and local level that you can join, and check to see if they have a tax committee. You know, advocacy is very important. You know, for instance, this past legislative session in Maryland, there was a bill that was proposed that would have taxed all services in Maryland. But the lobby came out very, very hard. You know, business community came out very, very hard against that bill. Yeah, so. And I'll keep going. You know, this is not an advertising pitch. You know, this is, you know, we've provided, you know, some tools, you know, some, you know, these aren't recommendations per se. These are more so examples of, you know, technology tools that you can use, you know, for managing your risk, you know, keeping your documents in order, and, you know, sort of becoming more efficient. And we have here that integration is key. And what does that mean? That means there's various types of technologies that you can use and leverage, but you need to make sure they flow together. You know, if you don't, you are going to spend hours and hours and hours, you know, trying to reconcile all of these different, you know, sort of documents that you have from these platforms that, you know, if they don't integrate, and it's going to become frustrating. And, you know, I really recommend doing your research and looking for software that integrates. But it is very important to sort of have you know, these basic tax, you know, technology tools, you know, in these areas, right? Something for document management, something for payroll, you know, something for software, you know, your tax software, even if you have an accountant, you know, and definitely something for mileage tracking, because that is an area of emphasis, you know. And when I was at the state, the word was contemporaneous. It needs to be you know, contemporaneous. Like you need to have this stuff. You need to be tracking as it happens, as opposed to going, you know, after the fact and trying to recreate. It's not going to be accepted most of the time.
And as you mentioned, it does help with the whole audit and review process. And I did mention on that slide where you were talking about AI, states and the federal government have been using analytical models for years, Maryland for more than a decade, to assist with audit selection and collection. And so having your documentation is key.
Right. And last but not least, we wanted to just leave some time for questions. And I guess, you know, we can, you know, we were asked to, you know, provide some final thoughts. Beverly, do you have any final thoughts? I mean, mine, I think we kept beating it in, right? You know, documentation, you know, I know it sounds, you know, it's coming from us, you know, you know, as tax professionals, right? You know, or in legal professionals, you know, but I can't emphasize how important it is to consult with tax professionals before making major decisions. And if you have the flexibility, consult with them, you know, before making minor decisions, because minor decisions now can have major tax implications down the line.
I'll say, my final thoughts are, when you look at the tax code, first of all, I commend you guys for being business owners, right? Because entrepreneurship is not for the weak. Okay, I will say that. Um, but it's a wonderful land to be in. The tax code really goes out of its way to reward business owners. So definitely take advantage of that. Going back to what DeAndre said, and this is what I see a lot of business owners, they end up faltering in, is they're not really able to take advantage of the tax code because they don't have good records. And having a good, uh, my mentor used to say, the way you make good decisions is through information, right? And so you have to have information. You have to make data-driven decisions. So the way you make data-driven decisions is by having good financial records. That means that if you can't sit down and review your books and records once a week, you should shoot for once every 2 weeks. If you can't do it once every 2 weeks, you should try to sit down once a month and organize what your financial work. Make it a date. Make it a date with you and yourself. Make it a date where, when I was a little girl, we always knew on the fourth Sunday, that's when the youth choir sang, right? So we always knew that every month, that the fourth Sunday, that's when I had to sing as a little girl. So I always say, look, make it the fourth Sunday or make it the fourth Saturday of the month that you have a date with yourself and your finances, and you go through your books and records, and then you put yourself in a position where, as DeAndre say, then you can schedule a meeting with your bookkeeper or your accountant, and then you can look to see, where is it that you're overspending? Where are the opportunities for tax planning? Because at the end of the year, it's going to be too much to try to figure out what your tax strategies are going to be. The clients that work with us, we work really year long, and we're constantly evaluating what their financial positions are and what it is that their goals, what are they trying to accomplish. So if we have somebody that might be trying to buy a house or position themselves to buy a house or to buy a building, to advance their business, then the finances need to kind of reflect what it is that your goals are. So some of the tax strategies we may use in this year, we may say, no, let's defer until the next year because we got to position ourselves to buy this building or buy a house or buy a car. So this is always constantly, there's always opportunities for you to really maximize the tax code and to position yourself to be really successful business owners.
Absolutely. And I guess a final thought is, just because, if you are listening to this and panicking and saying, I haven't been doing any of this and I've been in business for this many years, that's not a bad thing, right? Because a lot of what Beverly and I do is fix, right? We fix these issues, making sure, things that happened in the past, whether that be, offer and compromise with the the federal government or the state and say, hey, we've identified this issue, we've identified this mistake, we don't have the ability to fulfill this liability right now. However, we are going to offer this compromise, right? It's called an offer and compromise for a reason, and states, and the federal government, they appreciate it. They wouldn't have, complete, full sections, units that work through these things if they weren't willing to do them. And the same thing goes for voluntary disclosures. We talk about trust taxes, and there are it's a large portion of what I do, right? I have companies that come and say, we just didn't know. We weren't trying to not comply with the law. We just didn't know that we were supposed to collect taxes. And, it's like, we're not going to go after our clients, and say, oh, you should have paid us taxes on this. So they have to bear that burden of making those payments. And often we come in and we fix it and we get the liability as low as we can, through various mechanisms. And then, we disclose it to the state. And now they have a way to comply going forward. So, that is there, that don't be frightened if you have not been doing exactly what we said, because if everyone did exactly what we said, we wouldn't be giving this presentation.
And we didn't touch some of the more obscure things like abandoned property as a small business owner. I mean, if you have employees and someone left your organization and didn't pick up their last paycheck, you have obligations to excheat that type of property over to the state of Maryland. And if you don't, and other states also have unclaimed property, but speaking specifically of the DMV, and if you don't, then there are penalties associated for not complying with those laws as well. I know what we didn't touch on is, and since we do have a little bit of time, we wanted to share with you, and that's something else we can pop in the chat, but many of you may know that there were different what is the Tax Cut Jobs Act, what we call this TCJA, that was implemented several years ago, and they have expiring provisions of that act that could impact definitely you as individuals, but also you as small business owners. So I think that this year is very critical for business owners to consult with a tax professional so that they can be better prepared with how these expiring provisions may impact your tax filings. And this may be an opportunity where you may look to restructure because you may have made certain decisions just around what benefits you may have received from the TCJA that may or may not be in place. And what some people don't know is that Maryland, for some federal provisions, what we call couple, that they automatically follow the federal government if there's some type of legislation. But Maryland has a requirement that if any federal law that's passed has an impact on the state budget over a certain dollar amount, then the Bureau of Revenue Estimates has to review that provision and give a report to the legislatures, a 90-day report. And if it does have a budget impact, then they have the opportunity to not follow that federal provision, which we call decoupling. And so everybody's watching when and if any of these provisions will be renewed. And if they are, that has impacts on states and getting their tax systems ready and their forms ready for filing. So it can be, this year is very pivotal for a lot of people. So you really need to be on the lookout for what may take place. And I don't know if you have time to go over any of them. I can just name a few, but there are deductions related to the pass-through business income, and DeAndre referenced PTEs. There's limitation losses for non-corporate taxpayers that are in play.
With the cap, the SALT deduction caps falling off.
Definitely from the individual side. If they don't, you're right. If they don't renew it, which I think you have to watch this election as well to see whether or not some of these provisions will continue. But that is key, the SALT cap.
General note, but also because I just looked at Valerie's comment. Once again, I'm gonna beat this drum again. Consult with tax professionals before making, significant moves, right? I'm gonna speak this into existence for your company. If your company has not experienced, gains, right? And instead you've experienced losses, that's not always a bad thing. There are a lot of very, very, very large corporations, in the business world that have losses. And what do? They utilize those in years where their businesses become extremely profitable, right? So if your company's operating at a loss, there's something called a net operating loss, right? And net operating losses, can be carried forward, right? In depending on your business structure, right? So like I said, this is very, very, very fact specific, but there are definitely instances where losses can be leveraged when your company becomes profitable, right? So I'm gonna speak it into existence. Your company is gonna become very profitable this year, maybe next year, but don't restart. Don't restart before consulting with someone, right? You know, and giving up all of those losses. You know, because in tax, net operating losses are as good as gold. You know, in terms of strategizing. So, you know, definitely
True
consult.
documented losses because they could also trigger audits.
Yes, absolutely. All about that. Does anyone else have any questions for us for the order of the good or?
Let's see what else is in the chat.
Any questions that we didn't answer?
I think there is an open question. It says, this is from Jason. For 1099 versus W-2 employees is based on hours or days work. Is it different with areas of business? So we're talking about, I think, independent contractors generally versus W-2s and how do you actually classify them, right? And so it's not really based upon the hours or days worked. It's really based upon, it's like a 21 factor test. And DeAndre, you can definitely chime in because it's been a while since I looked at it. But if you go to the Department of Labor Licensing and Regulation, they have a very extensive list of what they deem is how you should classify an employee versus an independent contractor. So just to kind of name a few of the criteria or the test is, do you have financial control over that employee, right? Over that person. So even if they sign a contract as an independent contractor, are they basically like submitting, let's say, timesheets? Because timesheets are an indicator that they're actually a W-2 employee. Are they on the same schedule of payment that your employees are? That's an indicator that they are an employee. Do you have a desk set up for them at your office, right? Behavior control, that's the other one, behavior control. Are you telling them what to do every day, who to go see or what they should be working on? That's indicative that there are employees, right? Anything
Right.
else you want to add?
No, so it's funny. I got nervous. So I was joking before this presentation that I wanted to close all the windows on my screen because I was like, I don't want anything confidential to pop up as I'm clicking through. And I think I actually pulled up this presentation, you know, for a split second. But one of the things that I closed was a memorandum that I'm working on independent contractor classifications. And it's in 5 states. So here's how here's what's, like I said, every state wants to be a little different, right? So the federal government had, so what Beverly just talked about was basically the federal test, right? The common test that you know of, right? It's the ABC test, right? And she just said it, like, behavior control, like, sort of the direction that you provide, whether the services that they perform, whether or not they're in their usual or ordinary course of business, and what the business or trade is of that individual, whether it's customary for, someone that does whatever this individual, whether, say, I'm not going to say, employee or independent, whatever this individual does, whether that's something customarily done by an independent contractor or an employee. That's the federal test, right? Some states follow that general federal test. Some states have developed their own tests, right? So it really varies on it just depends on what jurisdiction you're going into, what jurisdiction you're having, these individuals go into. And that gets hard, right? When you are in tight quarters with, other states, right? Like when you have a business that operates in Maryland, but you have that you have customers in DC and Virginia, right? It's not, it's the laws of those states in some instances, if you're having them go over to someone's house and perform those services. So it really varies, and you have to, I recommend that companies, try to put together matrices, of these laws in these different states to figure out how they would apply in those instances. So that's not a clear-cut answer. It may be a clear-cut answer for federal purposes, but it probably isn't going to be a clear-cut answer for state and local tax purposes.
It is very muddy at the state level, and the test is different for unemployment insurance versus
Mm.
withholding, which makes it even more complicated. And I think a related topic has to do like with remote workers and where you withhold and which state you withhold, depending on where they're working. So as you mentioned, we could have a deeper dive into any of these topics, and would love to do something again in the future with getting feedback from everyone who attended today. And before we close, I did want to plug that the IRS, when we were talking about what resources may be available for folks, but the IRS every year has tax forums, and they're held all over the country. And the one that is being held this year, fortunately, is being held in Baltimore at the Inner Harbor, and it will be held August 13th through 15th. So when they get that final agenda out, we'll make certain that we share it with the Black Leadership Circle, and we can have that information for you and invite you to attend those tax forums. They are 2.5 days of seminars around federal law changes, as well as the Maryland Comptroller be present and share updates from the Maryland Comptroller's office. And it's just an opportunity to get information from both federal and state tax agencies. And I cannot thank both of you enough. People may not know the treat that we had today. Both Beverly and DeAndre are very prominent in our Maryland tax community as well as nationally, and present nationally. And you can tell that they have a passion for this, especially with getting this information to people who don't always have access to this information. And this is why we have formed a Black Leadership Circle and are partnering with Associated Black Charities. And we want to thank you again this evening, thank everyone who attended, and thank the Black Leadership Circle for providing this opportunity for us to be able to engage. So thank you, everyone, and enjoy the rest of your evening.
Thank you for having us, and
Thank you for
have a
having
great
us.
evening.
Yes.